7 cheat codes I now know 1,988 days into trading I wish I knew on day 1. Number 1 is leverage the power of the Holy Grail in trading. The Holy Grail in trading isn't one strategy that produces 100x or 200x, but it's actually a collection of uncorrelated ones. As billionaire hedge fund managers like Ray Dalio and the late Jim Simons have highlighted this, building a portfolio of these uncorrelated strategies or uncorrelated assets takes time and effort, but understanding this offers a clearer path. I'm Manir, also known as Ghost Dog Trades, and I also run Unbiased Trading, where we backtest and automate trader strategies. Let's continue into this thread. I actually want to play this clip of the late Jim Simons, where in his hedge fund, they run a collection of uncorrelated predictive signals, and that is what he at least mentions has really helped the returns of his portfolio.
To hire the best possible people, and the research goes on all the time. We're doing research, trying to find new predictive signals. New predictive signals. For example, that's a big example. So a signal is, well, you know what a signal is. It tells you what's a predictive signal is a signal that tells you what's gonna happen.
With some probability of right.
With a greater than probability greater than a half. And the more of these signals that you have, and independent, they're not correlated with each other. If they're highly correlated, it's really just one signal. But the more you have, the better. And we have, I won't even say the number, and I'm not sure what it is, but it's a very large number. Ahead of it.
As he mentions, they're doing a collection of uncorrelated predictive signals that is going to allow them to get better returns for the amount of risk they're getting and a more stable equity curve in that sense. 2 is respect the randomness of markets. Understand that markets are complex and not perfectly predictable. As Simons has said, patterns of price movements are not random, however they are close enough to random so that getting some edge out of it is not so easy and not so obvious. I think this kind of comes down to some people, particularly really smart individuals, come at the market thinking that it's an equation that can be solved. And hey, look, I'm not as smart as those sort of people, so maybe there's a stroke of truth into that. But at least from what I've heard from many hedge fund managers when they're hiring and things like that, they aren't looking for someone that is going to be able to be locked into that definition that there is a solution. A lot of modeling the markets and things like that is understanding that it's never going to be a perfect outcome. And even as Jim Simons says, he says that there's always an opportunity cost. There's always a pros and cons to an approach, and that's why most of the time a collection of those approaches normally produces the best results, as they can negate each other's risk. But yeah, understanding that and really respecting that there's always going to be randomness to the market. It's never going to just, perfectly replay what you imagine is going to happen. Even over a large enough sample size, it's only a higher prediction value that you will meet those returns or outcomes. And even then, as Cliff Asness said, another hedge fund manager, he always assumes that half of the outer sample return is what he will actually get. And there's a very big truth in that even someone like him that has $1 billion of resources and he runs Citadel, they can never be 100% guaranteed those sort of returns. They can only have a high percentage of predictability in those returns. 3, meticulous focus on preserving capital and managing downside risk. It only takes one event to blow up your capital, and without capital, you can't play the game. Have safeguards in place to protect against extreme events like circuit breakers, broker max loss, etc. This is incredibly simple, but it's just one of those fundamentals that traders find very hard to actually do and consistently do. I love another quote where he was pretty much mentioning the wisdom of Warren Buffett wasn't so much his genius in all of his stock picks, but more that he was incredibly consistent over that time and incredibly well at managing his risk over that time. And that was the pure genius in quotation marks of what he was able to do. So just really understand that if you do not have capital, you can't play the game. You should never risk to try and make an extra 1,000, extra 10,000, extra 100,000 if there's a chance that you're going to blow up your whole capital in the event of that. I would always prefer to make a less amount, but be more confident I'm always going to have my my capital be safe, because that means I can be in it for the long game. And as you're in trading for longer and longer, you learn more, you understand more, you've seen more historical events, you've gone through more mistakes, things like that, and you just become a better trader over time. 4, invest in quality data. Clean, accurate data is essential for developing and testing strategies. Ideally, you'll want at least 5 years of historical data, providing ample sample size and different market cycles to make sure your testing is statistically significant as possible. Key part of this is I see way too many traders still just doing manual data collection. There is a time and place for manual data collection, such as variables that are not able to collect historically using code or things like that. Or if you're just trying to get a general idea of a strategy and you're just doing a small sample, like 30 samples, just to see if it recently has been working, and then you dedicate more time or money to actually getting the proper historical data for it. But apart from those sort of nuanced situations, you really should be getting historical data to prove and test your strategies. If you're fully discretionary, then no worries, you can dismiss this point completely. But if you are wanting to be more systematic and have high conviction in your trading, you need that historical data, and you need accurate data as well. Manual data is incredibly easy to to put incorrect values, to miss values, to have a bias on it, all those sort of things. And people that say, yeah, but I'm really strict to my manual data tracking, I'm sorry, but I can never believe that personally. I have done previously lots of manual data tracking, and I thought sort of a similar strain of thought that, hey, look, I'm spending a lot of time on this, I think it'll be correct. I went through it, I think 2 years later, just to check and prove this point to someone, and there was numerous mistakes in it, and way more than the margin of error that you'll get with APIs or data providers, which is normally around 1 to 2% of that sample size, depending on how big the data is. So just don't waste your time doing manual data collection unless you're in one of those nuanced situations. At least that's just my opinion. 5, bigger account sizes. Starting with a small account is perfect, as you'll be facing the unknown, meaning there's a higher chance you'll lose it. But as you progress, a small account can really hinder your progress due to limited ability to diversify. I put a clip here in the original thread about Robert Caraveras speaking upon this topic. I think he doesn't say it the best with maybe giving a bit of nuance for like smaller for beginners, but he is 100% right that as you do grow as a trader, you want to diversify more. As diversifying, whether that be strategies, assets, whatever, that will allow you to have better risk management and better risk adjusted returns. And overall, you're not going to just blow up because one market crashes or one strategy fails or something like that, right? So having a small account can really hinder that, because even if you're doing futures, you're still going to have to meet margin on a lot of different assets. And obviously then you'll need to be able to have the drawdown of those strategies as well, and enough capital for that. So having a small account in those instances really can be a drawback that can really hinder your progress. But at the beginning, I would say up until the first year completed, having a small account is perfect. You really don't know so many things in your first year, and as you grow as a trader, you find out you don't know even more, and there's even more that you can learn. So if you're regretting that you only have $2,000 or $3,000 to start in the beginning, that's fine. Just keep with it, and you'll probably lose it. Just be ready to lose that amount, and take that off as just all the lessons you'll learn in the beginning. And then after that, yeah, you try and build a bigger account, as that will definitely help your progress with diversification. 6 is automation. For many traders, including myself, manual execution can be a major weakness. This could be due to human bias, reaction time, emotional volatility, etc. When possible, systemize and automate your process. The easiest to start with there is risk management. By what I mean with risk management, a lot of those things can be done simply within your platform. So if you have DAS, or you have NinjaTrader, or you have a broker or whatever, contact them and see if they have some sort of risk measures you can put in place, whether that be a max loss, daily loss, max amount of shares, max amount of trades, things like that. Those sort of things can be really easy to automate, and those are just handled by the platform itself. Now, there is a huge part there that if you can easily change them, then they're not very good, to be honest, because you'll, in those times where you do lose 5 times in a row and it stops you from trading, you could just go change it to 6 and then keep on trading. And I've done that previously. So try and make it on the broker side, and try and make it that you can't modify it on the day. You can only modify it like the next day or something like that. Apart from those risk management ones, are really simple to set up. From there, you could go into automating the entries, exits, stock selection, things like that. Which is going to really help you remove the human bias, really increase your reaction time. And then Full automation, personally, I think is the best solution to emotional volatility. That was the biggest thing I suffered when I was trading discretionary or with manual executions. And the reason for that is I'm good at making a logical and sound decision with enough time. If I have a day, if I have 2 days, if I have a couple of hours, I can make a good logical decision. If I am having to make a decision in 2 minutes or in a minute or 10 minutes, that probably is going to be highly emotional, and I wouldn't have thought it through fully. And I would have sort of convinced myself with some stupid logic that, hey, this is what I should do. Full automation helps bring that decision time to being a day, 2 days, a quarter, a month, things like that, where I'm simply managing the portfolio of strategies compared to managing individual trades. So if you suffer from similar things like that and you want my help to automate your strategy, just visit the link below in the description. It's unbiasedtrading.info, and we can help automate your particular strategies on whatever broker. And we've worked with over 200 traders now with backtesting and automation. 7, rigorously validate your strategies. This doesn't just filter out bad ideas, but it also builds huge conviction in your strategy and a more objective look over its expected performance. As Jim Simons has hugely emphasized, past performance is the best predictor of success. That doesn't mean it is guaranteed. It's just saying out of everything we have, past performance and statistics is the best predictor we can have. I attached a really good thread here where I went over robustness. I'm just going to cover some of them anyway for you. For rigorous testing, you really want to have obviously ample sample size. So you're doing 5 years, 10 years. You want a good amount of market cycles so that you can see it works in different varying conditions. And you can also see which conditions it works best in and which ones it works worst in. Then you'll want to do like Monte Carlos, which is just a more robust technique to see if the trade sequencing is a huge factor of that strategy and if it just got lucky. You'll want to do out of sample testing. You'll want to do parameter sensitivity testing. You'll also want to do like crash or worst case events testing, which is simply just testing it over like 2008 or testing it over 2020 and seeing if those events, how the strategy would have handled it and how you may want to adjust your risk measures or ultimate risk measures for those sort of events in case in the future. As normally, as Ernest Chan says, there's normally a big event like that every 2 years or so. So it's going to happen at some point if you're in trading long enough. And then another point I really put on this is building the conviction. Putting in that time or putting in that money or whatever into testing your strategy builds that conviction because you have spent ample time testing it properly. If you simply take a strategy out of a book and you start trading it, the first loss, the second loss, the third loss, you'll start doubting it. You'll think, oh, no, actually, I need to change this. I'm going to take a position here instead. And that's not sticking to a strategy. You're just ultimately discretionary trading, which is fine if you're really good at it. But at least for someone like me, I'm terrible at discretionary trading. I'm not very good at reading markets. I'm more better at researching and modeling strategies and then actually, implementing them. And then lastly, the objective look over it is, especially like a Monte Carlo testing and things like that, can give you a really good idea of what expected max drawdown there could be, what is the average return you could have, and those sort of metrics provide you with a way better, clear indication of how the strategy is going to perform potentially when you take it live. If you simply just do one backtest or you don't even do a backtest at all, if there's a strategy that has a month-long drawdown, for most people, that probably means they're going to stop trading it or they think it no longer works because it's a month. If it's taking about 1 trade a day, let's say that's 30 days of losses or, give or take, that's going to really break someone's conviction. If you have already previously backtested it and done rigorous testing and you know that, hey, on average, it's actually going to be a 2-month drawdown or a month drawdown, then that's going to feel completely different. You're going to be like, oh, that's fine. That's how my backtests have told me. I'm just going to wait that out and it's going to be fine. And most likely I'm waiting for a rebound afterwards. Obviously, that doesn't mean it's 100% guaranteed, but it is a better expectation of what is likely to come. If you find this sort of content valuable, feel free to follow me on Twitter at GhostHawkTrades or feel free to subscribe. Have a great day.